of investing onto the world of money management. So many investors have fled stocks, some of them huddling in bonds, some of them just trying to find a CD that'll pay a little bit more than zero. Our next guest has all kinds of ideas about that. We're so happy he's back in studio with us. Dave Edwards, he's the head of Huron Financial Group. Long career also on Wall Street and now advises and manages money for private investors. David, welcome.
Hey, good afternoon, Kathleen.
So hearkening back to your long, illustrious career on Wall Street, including Morgan Stanley and other big firms, what do you make of Jamie Dimon, the testimony? If I'm an investor or I'm just an American listening to this and thinking about how everything works, what am I supposed to take away from this?
Back in the late 80s, early 90s, I actually worked at J.P. Morgan Bank in the group that was developing the first value at risk models. And
which he says they don't rely on, by the way.
Yeah, well, the committee I was on was very interesting. There was myself with a 10-year history in bond trading, and then PhDs in statistics, economics, physics, mathematics, whatever. And we'd get around a committee table, and the gang would say, Dave, we've modeled this to 8 decimal places. And I go, I don't care. The trading spread's only 1 decimal place, number one. Number two, this model perfectly fits past history, but it has no predictive value. Things change, and our model doesn't. And they said, David, you don't understand. I go, no, you don't understand. So JP Morgan was the firm that was early into the value at risk model and also early developer of the credit default swap market. They still have about 30% market share among the top 6 banks. The problem for JP Morgan is that quite a few of their alumni have left JP Morgan Bank, taking the knowledge of those models and gone over to hedge funds. And so what we saw in the last 9 months was that the famed London whale trader got himself in trouble in September, doubled the position by December, doubled again by March, and then had to fess up and eat the loss.
How did they not see any of these red flags, though?
I don't know. I don't have the same relationship with JP Morgan I did 15, 20 years ago, but I do know from working on Wall Street for so many years that you always have to beware what we call the trader's option. Heads, I make a monster bonus. Tails, you lose a lot of money, but I don't have to give my bonus back. And I was kind of encouraged a couple of years ago when banks started to say, hey, we're going to pay you in restricted stock that vests over 3 years. But they never really seemed to be able to make that stick because then the guys would just leave and go to a hedge fund.
Does that kind of speak to the point, though, that guys who want to go to hedge funds should be in hedge funds, and that's great. And maybe, as old-fashioned as it sounds, we need 2 kinds of financial institutions. Jamie wants to have maybe, Mr. Dimon, I should say, all those the kinds of activities in one complex global institution, as he calls it, which does so much for the world, and it does in many ways. But some would say, like Paul Volcker or, Richard Fisher from the Dallas Fed, no, we need you kind of stodgy old commercial banks that take people's money and lend it out. And then we need the risk takers, and that's where all you smart high flyers can go.
Yes, and isn't that a funny return to history? Back in the late 20s, we had a kind of a Wild West Wall Street situation, and after the great stock market crash, Glass-Steagall was invented, and so that banks that wanted to be in the business of taking deposits and lending money were ring-fenced away from the risk takers. And so J.P. Morgan on one side and Morgan Stanley on the other side, and they lived separate parallel existences for the next 60 years until all that went away. Personally, I am totally cool with going back to that era. I don't think there's anything magical about finance. I've always said that it's like the 5 quarts of oil in your car. You need to have it there, but it's a commodity, easily replaced. And because of the way that markets developed over the last 30 years with the so-called innovation, the oil thought it was the gasoline, and it's not.
But with the current issue that they have and the current regulation that they have, it's really determining the line between prudent hedging and proprietary trading. Will they be able to do that quickly without a lot of regulation at this point?
Yeah, and the answer is probably not, because these models are very sophisticated, they're non-transparent, they're black box in many cases. I think I'd be hard-pressed myself to understand what's going on, let alone a 28-year-old regulator at the Federal Reserve.
I wanted to harken back to something we talked about last time you were on the show, and you mentioned that markets were rigged so there's no friction in prices up or down, and you meant in the sense of how a sailing ship is rigged. I question, is it rigged like a game? And now with what's happened with Facebook, we've had people like Jack Rivkin, from Neuberger Berman kind of defending, hey, that's what you do in an IPO. You try to get your investor, your IPO, all the money you can get. Morgan Stanley did great by Mark Zuckerberg, but
Right.
so much criticism heaped on him. What do you take away from
Yeah.
Facebook?
Yeah, no, I'm a big sailor by hobby, so when I think of rigging, I think of sailboats. But then you prompted me that there's another definition for rigged, which is a game that's set up to go against you. And I think it's certainly true that Morgan Stanley did their job in getting the highest possible price, and Mark Zuckerberg did his job by getting the most value for his fellow owners of Facebook. But I call it the Facebook face plant because, so many average Americans jumped out of the markets in March 2009, and I'm not talking about middle-class families. I'm talking about high net worth families with, high six-figure incomes and seven-figure portfolios. They went to 100% cash in March 2009, and they've been sitting on their hands ever since. We had the big rally through the end of March, and they were just about thinking that maybe they would, maybe get some money back in the market, and maybe they would start with Facebook, and they lost 20% in the first day, and they just ran away. The wallet slapped shut.
But we talk a lot about these day-to-day moves in Facebook. If you're a long-term investor, what is the growth looking like for them, and will it be stronger later on?
If you're a long-term investor like us, you'll be intrigued by Facebook when it gets down to about $1 a share. Because
$1?
Oh, sure. Because right now they have about $3 billion in revenue, right? So you put any kind of reasonable multiple on that gives you a firm worth maybe $3, $4, $6 billion. Well, that's a long way from where it's trading right now.
It certainly is.
Yeah, it's 27.54 right now.
And that works out to about $60 billion in market cap.
So what's the moral of the story, my friend?
Moral of the story is one IPO in 100 is successful for average investors. Stay away.
I had that conversation with so many people. I can't believe the number of people who were surprised this happened. It happens over and over with IPOs.
Vonage down 90% from its IPO, same week as Google.
Well,
and Zynga's big drop this past week, too.
So we'll keep reminding people. We'll do our best. David Edwards is just getting started with us here in Financial Group. We're going to talk more about some of the big issues confronting investors. Stock market. What about the summer? What about bonds? What can you do with your money? Should you just wait till next fall? Find out next. Let's get right back to David Edwards. He's the founder and head of Huron Financial Group, wealth advisory firm. And of course, as you were listening earlier in the conversation, you know that David has had a long career on Wall Street. J.P. Morgan, where else?
Morgan Stanley, Nomura, my own firm for 20 years now.
There you go. So I love the combination, though, of having worked on the street and been at that sort of higher institutional big bank level, and now managing money for individuals. And of course, you have kind of higher net worth customers, but one of the reasons we like to have you on the show is to impart your knowledge to people maybe who can't afford your services but would like your knowledge.
Yeah, it helps to know how the sausage is made.
Indeed. Well, what should we know right now about the markets, about the dynamics? Because look, let's say I am scared of stocks, and let's say Facebook doubly scared me away. But let's say I might even have some money to invest. At some point, I should be putting it to work, right?
Yep.
So how do I think about it? I've got a European debt crisis on one side, got maybe a slower economy on the other side. What am I supposed to do
Yeah,
here?
and I've talked to so many wealthy families that have. I talked to one guy who has $5 million spread across 20 banks, and he's a number 5 executive at an S&P 500 company. And I said, why? He said, well, Dave, if the financial system collapses, I'll have the FDIC insurance. And I go, okay, seriously, if the financial system collapses, it won't be FDIC insurance, number one. Number two, how's your company doing? Oh, fantastic. Record revenues, record earnings. We're expanding in Asia. It just couldn't be better. Really? So there's a disconnect between your perception that Western civilization is about to end and the fact that your company is doing really well. One of those things can't be true. Which is it? And he said, I'll get back to you on that. And so we talk every 6 months, and I say, well, what would get you to put some money in the market now? He says, well, I only want to get back in when all the problems are solved. I go, well, that could be never, because that's history.
Yeah.
I said, well, maybe if the market pulls back. I said, really? It pulled back last fall, but you didn't step up. And it pulled again back in May, but you didn't step up. So when is this magical event going to happen? And I finally decided that the only way to sort of get the logjam going is to say, look, let's take a portion of your money, a quarter, let's say, and put it to work this year. and then check back in a year and put another quarter to work, and then another, and then another. The worst case scenario is you'll miss out some upside. The alternative scenario is the market pulls back and you get more shares at a cheaper price. So a lot of my work these days has nothing to do with investment analysis and everything to do with managing investor behavior, managing investor
Behavioral
psychology.
finance.
You know, and the other thing that I've noticed very interesting that among my older clients in their 70s and 80s, they're very sanguine because they've been through the Great Depression, World War II, Korean War, Vietnam War, death of Kennedy, Robert Kennedy, Martin Luther King, right? They know that bad stuff happens and they can deal with it. And the younger clients, also 40 and younger, are also pretty sanguine because all they've known is suck since they got out of college. It's the ones in between 40 and 65, that had a pretty easy life up till now with cheap education and cheap housing and good jobs that paid pensions, whatever, and all of a sudden they're seeing that they're undersaved for retirement, and they're getting a lot of bad and conflicting advice. And it's very hard for old school risk-averse managers like myself that adhere to the fiduciary standard to rise above that level of noise and get them to do what they need to do.
With that small bit of money that you're talking about, what specifically are you telling investors to be in?
If it was not one of my clients, you know, because they didn't have enough money with me, I'd say, look, keep it real simple. Start with your Vanguard Index 500 mutual fund or the ETF, or maybe the Fidelity All Market Russell 3000 version, whatever. And then with each decade of life, add 10% fixed income. So if you're 40, it's 100% in stocks. If you're 50, it's 10%. If you're 60, 20, and then 70 or 30. Right? If you do nothing else, if you can just commit to that real basic index strategy, you'll be fine.
So right now, so many people of all ages have losses still because they didn't get out in time, right? Or they're told to stay in stocks, and so they might still be underwater on a lot of positions. If they're going to add to positions, a lot of people also promote getting your income growth with, you know, large cap, high quality dividend payers.
That totally makes sense. But you know, when you look at one of our sophisticated portfolios, it's going to have an allocation to large cap stocks, of which some are going to be dividend providers. There's going to be mid caps. There's going to be small caps. There's going to be REITs that have high dividends. There's going to be a 5% exposure to commodities. Commodities are very volatile, but the long-term trend is up. We're going to have 15% exposure to international stocks, of which 10% will be developed markets and 5% will be emerging, because as intriguing as China and India are, those stocks are even more volatile than commodities. And then we're going to have big chunks of fixed income in munis and corporates. We actually are going to build a portfolio that will survive in all weather conditions. Too many people get suckered into, oh, I should buy the leveraged gold ETF because Goldman Sachs says it's going to 2,500. And then it goes to 1,600 and they have their eyeballs ripped out.
Well, and I guess that speaks to partly to diversification. Maybe a little gold's okay. It also kind of applies to this sense of, because a lot of people are questioning buy and hold, you know. They say buy and hold can hurt you too, because Marianne Bartels, Bank of America Merrill Lynch, she's chief technical analyst. Her call is still that gold eventually is getting somewhere in the $2,000 to $3,000 range.
Yep.
So if you can, I think with part of it then, can you ride it down to 1,600 and be patient that it's actually going to go back above 2,000 some point?
In our case, it's 1% or less of our total allocation, of course we can. But too many people do it all or nothing, 100% in, and then they're forced out by a margin call, or they just can't take the pain, and now they've just chopped off 25% of their capital, which they've got to now earn 35% just to get back to break even.
Okay, so you say put some money in. You know, the worst is you know, that you'll miss some of the move, or you know, you can pick up stocks at a cheaper price. Got a little time left here, just a bit. What is your sense of the stock market? Is it going to? Are we going to see more down before we see the up?
My forecast for 2012 was 12% on January 1st. By the end of March, we were already up 13%. So I said, well, either it's going to go sideways the rest of the year, not likely. We're going to get a buying panic as underinvested people finally jump in, up 20%, or we're going to have an exogenous event. They will not get back down again. And that's exactly what happened. Stocks are better value today than they were a month ago. And if you have any thoughts about getting involved, I would go now.
10 seconds, lots of volatility, though?
I pay no attention to what happens day by day. I don't care at all.
Well, then, gosh, I guess we better keep our focus on long and medium-term events, Courtney, so people like David will listen to us. In fact, we're going to hold them around just for a couple more questions on the markets, on investing, and what a regular person can do with their money. This is the Hayes Advantage on Bloomberg Radio. I'm Kathleen Hayes. Courtney Donahoe in for Bonnie Quinn today. And in the next segment, the next hour, Founders. You're going to want to know what this is. We want to get back to David Edwards. He's the head of Huron Financial Group. He agreed to stick around for a couple more questions. One of them, David, is a question from a listener because we were talking about Facebook, and you reminded our listeners that, you call it Facebook face plant.
Correct.
It has done what most IPOs do. You're lucky if they run up and then they just come way down. And if you bought on the IPO, too bad. But Stephen writes in saying, I'm not in the IPO market, but don't underwriters want to leave some money on the table to create a post-IPO marketplace? And I think we hear that so much. If they don't, they hurt the capital markets. Again, I don't know if I'm cynical or realistic, but it seems to me that, again, basically, if you're underwriting an IPO, you want to get max value for the company.
I don't think everybody realizes that when a company like Facebook comes to market, they're not selling 100% of the market, 100% of the company on the first day. They're actually selling 10% or 15% to establish some float. So it's actually more beneficial to price the Facebook IPO at 24 and have it rise to 30 than have it IPO at 38 and fall to 30. The institutions immediately sold on the day. The venture capitalists all got out. So many retail people were in and out in the first day. Well, so now any possible demand for that stock has dried up. When the real public process takes place, when the lockup period expires, which I think is maybe 6 months from now, typically 6 months, 9 months, whatever, and people start dribbling those shares in, it's going to come way down. And so, yeah, a firm like mine, we like Faceplant. We use it for Faceplant. We use it for our. We use Facebook for our social media strategy. I love seeing my friends' pictures and everything. But as an investment advisor, it has a lot less intrinsic value.
I want to turn your focus over to Greece. Elections coming up this weekend.
Yep.
What are we going to see?
It doesn't matter at this point. I think the kindest thing to do would be to kick Greece out of the Eurozone and let them go their own way. There's so much talk about Greece in the financial media in the last year, and people forget that Greece is a tiny country on the periphery of the Eurozone. In 2010, Greece and Maryland had the same GDP. Now I think Greece is about 20% less. So at a certain point you say, you know what, rip that Band-Aid off, push that country out of the Eurozone, let them go back to the drachma, let the bankers take the losses, and then get on to solving the real problems.
So as a sort of a segue to our next guest, what about investing in small startup kind of companies or in the firms that invest in them? Is that purely for the big professionals?
As a matter of fact, my firm is a co-sponsor of a venture capital forum every 3 months here in New York, and my interest is not in investing in the companies that are looking for capital. My interest is in meeting the founders of those companies so that 5 years from now when they need me, they know where to turn. For my clients who are relying on their portfolios for their retirement, it's too risky for them.
Well, then you're going to want to stick around, and maybe during the break you can meet the founders of Founder. But David Edwards, as always, such a fascinating conversation when you join us on the show. Thanks so much.
Thank you. What a pleasure.
He's the founder and president of Huron Financial Group.